Hey, what's going on, guys? Welcome back, Marriage, Money, and Mindset. We are your hosts. I'm Jared.
And I'm Alexis.
And we are back, guys. Episode 9. Episode 9 of Marriage, Money, and Mindset. We're going to be discussing exiting the stock market today. Continuation of this month's stock market conversation. Last episode, episode 8, we discussed, what was it? Picking companies to invest. Choosing companies to invest in, right? So, of course, this episode, we're trying to do a certain order, guys. We're trying to, the very first episode was about what is the stock market. The second one was about setting up your brokerage. The third,
like step by step.
Step by step, right? Mm-hmm. So we often get asked, exiting the stock market. How do we exit the stock market? So that's something that we want to kind of touch on, giving you guys some ideas on what to consider when exiting the stock market, right? But before we start, guys, thank y'all for tuning in this week. If y'all haven't seen those other videos in regards to the stock market, make sure y'all check them out, share them. If you've already subscribed, thank y'all. We got some new subscribers. Thank y'all for subscribing. Follow us on IG as well, Instagram. And we appreciate y'all support. Yeah, so we're gonna keep coming for y'all as long as y'all, keep coming for us. So exit in the stock market. That's gonna be today's topic of discussion. Okay, so let's dive in, right? Mm-hmm. So exit in the stock market, it can be a significant financial decision, and then, like I said, we want to touch on these 10 specific considerations. Again, guys, this is just some things to consider, not the end all be all, right? So let's dive into the very first thing. You have to make sure it aligns with your investment goals, okay? Right. So going in before you even start, you need to have your investment goals intact. You need to know basically why you are buying stocks or why are you investing in the stock market.
Why that particular company.
Yeah, exactly.
Just know your why.
Yeah, but also have an end in mind goal, right? Mm-hmm. That's how we started. Of course, we had our investment goals is to basically supplement our income in retirement or for retirement. That's the goal that we set for us why we invest in the stock market. That's our investment goal.
Right.
So for you need to review your investment objectives. Are you exiting for short-term gains, rebalancing, or for the long-term reasons like retirement? Exactly what we just mentioned, right? Mm-hmm. Okay, so let's talk about market conditions. Number 2, market conditions. So assess the overall market conditions. Are there signs of a bear market or a recession? Consider the economic environment. Are you exiting because you have a significant loss, drawing down your portfolio? And I want to quote this guy real quick. This guy by the name of Wall Street Trapper we researched. He says, once the reason I bought the company goes away, then it's time to exit, right? So this past week has been terrible. Well, some people may consider it to be terrible.
Yeah.
The conditions of the stock market, the treasury yields, that's what's been kind of drawing down most positions. They've actually hit records this week in the trading market. And the 10-year is now at its highest since, I think, 2007, the 10-year treasury yield. So a lot of people are fearful of the stocks right now. But again, that doesn't always necessarily mean it's a bad time. Because for us, our time horizon, right, is so far ahead, we're nowhere near where we want to exit the market. So buying discounted shares is actually an advantage for us. So that's another way you should look at it. I know when you pull up and when you open your portfolio on your phone and see red, everything's down, significant gain, losses.
It can be scary.
It can be oh man, I'm losing all my money. Some people may think that, but you're not. Again, we mentioned it before. You don't lose your money until you actually execute a sale. Right. If you sell for a loss, then now you have a realized loss. Mm-hmm. But market conditions, that's basically, consider the market conditions. Are we in a bear market? I would say maybe if you're further down in retirement, man, and it's eating away your retirement fund, mm-hmm. then yeah, you may be more inclined to want to maybe sell off a significant portion
Yeah.
and put it maybe in a treasury or just be in cash. You know, everybody is unique, right? So
ideally
yeah.
reinvest it into something that provides a return, some
Well,
sort
we're
of
gonna
return.
get that's something we're gonna talk about here.
Yeah.
You say you kind of going too fast. Slow
Okay.
down, little one. Hey, okay. So, guys, number 3, right? Portfolio diversification. Ensure your decision aligns with your overall portfolio diversification strategy. Exiting one asset class might impact your risk exposure. You know, you don't want to be just solely in one industry like we discussed before. Now, of course, we did mention that we're majority of our portfolio that we have with currently TD Ameritrade is majority tech. However, that's not the only fund or that's not the only account that we have. So we do have other portfolios with different companies that we invest in. Some are actually a little bit more diversified than this particular fund. This particular portfolio is just more exposure to the companies that we have in a diversified portfolio that we invest in. So, but again, you don't want to be solely in one company, one industry. That's terrible. In my opinion, that would be a terrible, very risky strategy. You know, going all in just solely on one company and relying on that to, you know, take care of your financial future. So make sure you have some type of diversification. And we also talked about diversification, not only just within the stock market, but other asset classes such as like real estate, right? Okay, so number 4.
Tax implications. So understand the consequences, your tax implications. If you hold for a year and a day, then you're going to be taxed as a long-term capital gain. If you exit anytime before a year and a day, it's going to be taxed at short-term capital gains.
Yeah,
so you'll be taxed higher.
Yeah. Yeah, we always, you know, we touched on that. Now, there are some strategies where you can mitigate those taxes, okay? Unfortunately, this video, we're not going to really go into details on that, but we will just stay tuned. We're going to give y'all some strategy on how you can actually mitigate what you have to pay in tax towards your gains that you, or towards your stock when you sell. Because yeah, you do have to pay tax, but you can mitigate it. So just something to consider, of course, when you're exiting the stock market. Number 5, the last thing on this page, that's what I mentioned.
Number 5 is risk tolerance. So your risk tolerance may change over time. Again, whenever you're younger in age, you may be able to have higher risk than what you would at an older age.
Right. Yeah, you could be a lot more aggressive.
Right.
When you're younger, right? Because you have time to recover. That's the point. Like if you may start just in individual companies, such as what we're doing, you know, the companies we're invested in, we've done our research, we've done our due diligence. But at some point in time, when we start liquidating those shares, yeah, we're going to use it to live on. However, we're also going to reinvest a portion of that. Now, where we reinvest, that's where we want to be a little bit more conservative because we now are trying to preserve our wealth. We're not trying to continue to add risk or be super aggressive, right? Mm-hmm. Yeah, we want to mitigate risk. We want to reduce risk. We want to preserve the wealth. And then, of course, still average a decent return on that. So that's basically, you know, how you should evaluate when it comes to risk, your risk tolerance. Okay. Number 6, financial needs. This is a big one. Financial needs. Assess your financial needs. Do you need the funds for a specific purpose or emergency? So a lot of folks, man, this is why I think, you know, investing in your own brokerage sometimes can be detrimental because you have access to being able to liquidate. Like that's the thing about stocks is illiquid. I'm sorry, they're liquid, not illiquid.
Right.
Now, real estate, that's illiquid. Now, I'll explain the difference real quick to summarize what that means. So liquidity, being liquid means you can easily access those funds, right? Just with the click of a button, you can sell your shares. And then, of course, you can now deposit those funds into your bank account. Well, like for real estate, you know, if you want to access your equity, you only have 2 options, really. You can sell the property. And then, of course, you have to pay tax if it's an investment. Mm-hmm. Or you can refinance, which is where you go back to a lender and they'll give you a percentage of what the structure is actually valued. It's usually between 80 to 85% at the max. But that takes a while. That's a process. You know, it could take anywhere from 30 to 60 days maybe, you know, and then of course, you have to get an appraisal. We'll talk about that in another video as far as like, well, real estate, how you can access your equity. But basically what I'm saying all this to say, you know, try to consider, like, use other alternative ways for your emergencies. You know, I would definitely consider like exhausting other, whether it be credit, you know. I mean, we're not telling you to get into debt for an emergency, but think about it. I actually had this conversation with a coworker. We were talking about eliminating debt versus investing. You know, like if you have extra income, should you invest it or should you focus on paying off your debts? Me personally, again, it goes back to your age. If you're young and you're trying to pay off your debt like expeditiously and you have the you have the funds that's coming in to do that, I highly recommend that you invest that money. And if you put it in the right investments, the interest you're going to gain in comparison to the interest you're attempting to save is going to be disproportionate, meaning you'll have way more gains in the long term than what you're going to have in savings on the short term for paying off your debt. That's just my personal opinion.
Right.
But of course, you can do both simultaneously, right? You definitely want to make sure you're trying to max out certain accounts too. Like if you have a Roth, everybody, in my opinion, you need to figure out a way to max that out. And once you check that box, then you can, access other investment vehicles like an individual or a joint if you're married, things of that nature, right? Like a deferred comp, you can max that out. That's an account where you put your money in pre-tax, where you get a write-off, for that fiscal year when you file your income tax. So those are things to think about, like I said, guys, you don't want to ever have to really sell
whenever
portfolio.
You sell your stocks, the oldest shares sell off first.
Yeah,
so it's going to change up your
FIFO. I think that's the acronym for that.
First in,
first out. Yeah.
It's going to change your cost basis.
Right. Oh yeah, your cost basis is going to, anytime you purchase and sell shares, it always affects your cost basis. That's a good point too. Cost basis is basically where it averages out what your investment, what you paid for that investment. Try to break it down. Like if you
across all your shares, it's an average.
Yeah, as an average. Yeah. Like if you bought one share for $100 and then you got another share for $50, well, your total is $150, but on average is $75. That would be your cost basis. That makes sense? Yeah, because you would take the average of what you spent for the two shares. So that's just some simple math. Yeah. But anyway, guys, so try not to sell your assets for emergencies, because it's not a matter of if, it's when. And we're strong about that. We're like, hey, we'll exhaust other options before we sell shares for an emergency. Right. That would be our last resort if we just had to. But I'll exhaust our credit. I'll exhaust, whatever. Yeah. And that's another cool thing about the brokerage that we have. You can borrow against it. If you have to, you can borrow against it and use that for emergencies. And then just manage the interest. That's the cost of doing business, right?
Right.
So guys, let's not do that. Let's not sell, whenever our financial needs, emergencies occur. So number 7, company fundamentals. Company fundamentals, if you're invested in individual stocks, evaluate the financial health and performance of the companies you're holding. So that's something we talked about last video, was the financial health of a company. Going in, make sure you do your research. But again, things happen to companies as well. Sometimes, things may take a turn. Revenue may not be as high. The
management could change.
Right. Yeah, exactly. Monitor the companies you're invested in. If you're in individual companies, make sure you're monitoring their fundamentals. If things change drastically, maybe a good time to maybe consider getting out of that position. Yeah. Because of the fundamentals changing, the margins aren't the same, the revenues changed. They're not cash flow positive anymore. Maybe they stop paying a dividend, things like that, right? So that would be, the fundamentals of a company to consider when exiting. Number 8, psychological factors. This is a big one too.
Yeah.
Psychological factors. Emotions can play a significant role. Don't let fear or greed drive your decisions. Have a well thought out plan. You want to talk about that?
Basically, the whole market is emotional. So whenever the market is up, you're not wanting to sell your shares. I mean, well, whenever the market is up, you do want to take partial profit, depending on your strategy.
Yeah.
But whenever the market is in red, don't be fearful and like pull out of those companies.
Yeah. Try to have the reverse psychology going, guys. Like when the market's in the red,
Buy.
look at it like a sell. Like
Right.
whatever you're into, whether it be like fashion, I don't know, whatever your taste is, jewelry, shoes, whatever, right? When those things gonna sell, what do? Y'all run to the market. Y'all run to that store. Y'all run to, the whatever, right?
Right.
Try to do the same thing in the stock market. When you see, like, I ain't gonna lie, when I saw Tesla go down this week, time to add to this position.
Right.
Now, it's still, I bought the dip and it keeps dipping.
Now that you don't know. I mean,
yeah, but you
nobody
can't time
ever
this market,
knows
right?
the bottom.
Yeah, exactly. So you never, that's what I'm saying. Like, I always tell people, like, if you do have a significant portion that you want to invest, don't do it all at once.
Dollar
Average
cost
it in.
average.
Dollar cost average. That way, if it keeps going down, you can keep lowering your cost basis, right?
Right.
So try not to go all in at one time thinking that this is the bottom, because it may not be. It may keep dipping. There's a little meme I always send you, a guy with the coffee shaking. I bought the dip and it keeps dipping.
Yeah.
So don't be that guy.
Right.
But yeah, or just make sure you have cash to continue to buy as it continues to dip. And then of course the opposite, when it goes up, the market, like she mentioned, when it's in the green and it's hitting new all-time highs where everybody who's in that position is in the green and everybody's positive. And depending on when you got in, hey, maybe a good time to maybe consider taking some profits off the table and reallocating them elsewhere in your portfolio, or just saving them.
Or to buy at a lower price.
Yeah, or maybe buy some shares back at once the market kind of calms back down. So, whatever your strategy is, right? But basically, the psychology of the stock market is, people do the opposite. When the market's going up, that's when they're buying.
Right.
And when the market's coming down, they're selling.
Yes.
Don't do that. That's
Right.
not what you should do, in my opinion. Mainly, you get a lot of people trading. Like, I think the traders hop in and hop out whenever the market's trending upward. Like, I showed you some stuff in my phone before. It was in a group. Guys buying, there was a group text I was in where guys bought some stocks that were just, meme stocks basically at the time. Got in, got out real quick, made some money. But my thing is, what do you do next with the money, right? So you may have a nice win, you have a win, but where you put that win next really is where I feel like, it's going to ultimately determine if you won or not.
Right. Because
if I go and let's say I make $5,000 real quick, but I go put the $5,000 in something and I lose it, technically I didn't win. I mean, I lost.
Right.
So, but just know that it could be psychological. That's why I said before in another video, it's emotional. So you do have to have your emotions intact if you're going to invest in the stock market and manage your own portfolio. Right. Okay. So number 9, long-term perspective. Keep a long-term perspective. Exiting the market should fit into your broader financial strategy. Like we mentioned earlier, that's our strategy, is long-term. So we already set it in stone when we're going to liquidate our shares. It's only for retirement purposes. And then of course, we still reinvest in a portion of that, which is the last step, reinvestment strategy.
Right.
So if you plan to reinvest elsewhere, have a strategy in place for when and where you'll reinvest. Will it be in other asset classes like bonds, real estate, or cash? So what we advise, of course, is to exit and reinvest a portion of your income, but reinvest a portion of your income into something probably more conservative, because in your later stages in life, your goal is to preserve your wealth, right? That income is going to last you for your lifetime. So you don't want to put it in something that's going to have too much of a risk on it, or put it in an investment where it's too risky and you have not only are you not earning any interest, but you're not losing the capital that you invested. So you don't want to do that, right? And that's pretty much it, guys. Like this.
So we are not financial advisors. So we didn't say that in the beginning, but some external factors to think about in order to buy shares. So if the inflation is high, if there's an increase in raw material price, a fall in demand, or an increase in competition. Some internal factors to know when to sell: poor management decisions, unethical business practices. We talked about that earlier. Frequent changes in leadership or lack of corporate governance. Governance. I don't know how to say that.
Okay.
Yeah.
Well, elaborate on some of that. Help me out.
Yeah. So basically, when to know when to buy and when to sell. So this whole episode is about when to sell stocks.
Right.
And typically, you don't want to sell, but some of those things that I just mentioned, such as some of the internal things in a company changing, like management or the business practices are changing up. They don't
Financial health.
Yeah, the financial health of the business
Okay.
dips, then you may want to consider selling that company. Would
Like
you
I
say
said-
Wall Street Sharper says?
Yeah, basically the reason I purchased it, when that goes away, maybe time to get out, right?
Right.
But guys, look, this all we're saying is just know your plan going in. Before you even start, that's the first thing I think you should think about is, okay, at what point am I going to get out? And it's okay if you're a trader, if you say, hey, I'm only going to buy this position. Once it hit this amount, I'm going to get out. And it is what it is. You move on. It's not a big deal for you to, don't get emotional about the company you're invested in either. Like, to me, I feel like the financial health of a company is
Outweighs.
it outweighs the company. Like, some people, man, they like diehard fans. It's not about ego. This is about securing your financial future.
Right.
So if you're in a company and it just starts going south, hey man, look, move on. It's time to go. It's time to move on and find a different company to invest in. You don't want to keep dollar cost averaging into a dying business, right? So guys, that's just what we wanted to, assist with today on talking about how and when to exit the stock market from our perspective. Hopefully we gave y'all some value today. Make sure you like, share, subscribe. What else? Anything else you want to mention? Thank Alex again. We didn't tell y'all. Thank Alex. Alex is a guy that we're working with, TPE. Y'all go check us out on his channel as well. We drop content with him. Y'all go show him some love. Subscribe to his channel as well. Anything else? Any other?
No, that's it. Y'all have a good week.
Okay, guys. Y'all take care.
Peace.